Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options S&P 500 U.S. market update. Since our last recording, that upward zigzag remains qualified and current. Over the last week or so, some of you may have heard on the financial networks talk of a melt up in the markets towards the end of the year. What exactly is a melt up? Let's take a look and I'll show you. For those of you that are regular watchers, just use this as a reminder while I bring those that may be watching us for the first time in this video up to date. The zigzag that I was talking about in the intro is this pattern here, where we had the A wave extension followed by a B wave correction right to the 61.8% fib level, followed by potential C wave extension right to that 381 level that we've been talking about for quite some time. Located within there, we had this flat pattern that created a complex wave 5 in addition to the fact that we had a zigzag already, so that made it complex as well. And then we had this thrust type of a move, something you normally see coming out of a triangle off of the end of that flat pattern as we've moved to the upside, the wave 5 relabeled, and we have new closing highs. Now at the close yesterday, and I'll just walk this chart back a day, as we closed yesterday, looking at the 10-day moving average, you can see that we had a little bit of separation there. So the fact that we had a quiet day today is actually pretty expected. Now we do have a doji on the chart today. At this point in time, the futures are down about 12, so hard to tell exactly where we're going to go from here. We could have just been testing that 61.8% level and ready to move back to the upside. Now also in the intro, I mentioned a melt up. What causes a melt up? Well, there are several factors that are included in this melt up theory. One is we're entering into a seasonally bullish time of the year. We move into the point where the markets tend to kind of drift higher, hence the melt up thing. It's a low volume, low volatility, drift to the upside as we move in the holidays. People are on vacation. There's not a whole lot of trading going on. Something else that could spur it to the upside I wanted to share with you is this chart here of the 10-2 Treasury yield spread. So this is the 10-year and the 2-year spread. A lot of people watch this. I've mentioned numerous times that if you want to be a good equities trader, you really have to pay attention to what's going on in the bond market. Now the way this works is as it approaches zero, that means that the interest for a 10-year and a 2-year are the same. Now, that really doesn't make a lot of sense, does it? You should make more, you should earn more interest for holding a treasury 10 years versus only holding it 2 years. So it's not a good sign, not a sign of economic health. Now, since the end of August or September, we've been trending to the upside, and we're at 72 basis points now. If you're wondering, is that high? Relatively speaking, well, the norm is 93 basis points. So we're still well below the norm, but the fact that the 10-2 spread is increasing is actually a good sign. What would be the first thing you would think of when you see this kind of a spread? Financials. So let's take a look at the XLF. And as you can see, boom, we came out of this, another flat right here with the same type of a blast off move that occurred in the S&P to the upside here. And with that move, we've created a new high in the XLF, looking like we want to continue to the upside. Taking a look at the DMI, you can see that wow, we are just starting to get the signal like this wave 3 has a long ways to go. That's a good DMI as far as a trend forming that has good strength to it and expected to continue. Now, I can't give you individual investment advice, but in tonight's Trade Finder webinar, we did talk about some case study considerations that go along with the financial sector and those that have the best chart patterns. If you haven't attended a Trade Finder, I invite you to join us. It's free, and we do, again, talk about the market and some case study considerations. Other things to look at that could move this market to the upside as well is the dollar. Now that one's a little bit interesting. You can see that the dollar is starting to trend lower. And we've talked about this in the past. A lower dollar in general is good because of the exchange rate for international companies. We just don't want the dollar to collapse. That's then a sign of economic weakness, obviously. When we take a look at this, we had this wave 5 move to the downside, and the corrective move when you have a wave 5 that extends more than 100% by Elliott Wave rules is you get at most a 61.8% corrective move. You can see here we corrected exactly 50%. So we moved to the 50% level, came down. We've now tested with a doji the 38.2% level, and then we're headed down again. Now today's close did not take out the closing low of August 31st, but boy, we're getting awfully close to it. So that could help as long as it continues to the downside without an overall collapse. Looking at interest rates, following along with the theme of that 10-2 spread that I was showing. Here's interest rates on the 10-year. You can see we got just a bit overbought, if you will, or rates got away from the 10-day moving average. So some sort of a consolidation was expected, and that's exactly what happened. We've come back down to that 10-day moving average. Now, interestingly, in today's move, we look like we were going to continue to the upside, but we fell back below the 10-day moving average. Now, maybe we're just coming down to fill this gap, but that could possibly be a sign of early weakness. We'll just have to wait and see. So correspondingly, you would expect the 10-year bond to be moving to the upside, and it has a bit, but it's still in a downward pattern. So something has to change. So we have bond prices that are still in a downtrend. We have a market that's moving to the upside. We have rates that are coming a little bit lower. There's a little bit of a discrepancy there, divergence, and one of those two is going to change. Either the market's going to move to the downside and money continues to move into the bond market, or money comes out of the bond market, interest rates turn and go back to the upside, and the market continues higher and reaches that 381 level. Now, you could certainly imagine a scenario with this melt up. Another piece of that is once we get to Christmas, we have that week after Christmas, between Christmas and New Year's, known as the Santa Claus rally, another very low volume period of time when the market tends to drift to the upside. All these scenarios, you can imagine causing that market to go up and hit that 381 level. But then at that point in time, that's going to be when we're going to have to take another look at where things are. So that's a consideration on the melt up theory. What do you think? Post a comment. Where do you think we're going between now and in the end of the year? And if you like these videos, please hit that like button. Thanks for watching. Talk to you again soon. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.